Hello, and thank you for joining me. My name is John Occhi. I'm a realtor with Keller Williams and the Excellence in Real Estate team. This is the fourth part of my special report on leveraging property, how to buy property using little or no of your own money, whether it's residential property or investment or even commercial property. All right, so without further ado, let's jump into this. We're talking in this section about buying from a motivated seller. And by a motivated seller, we're talking about somebody that needs to move, okay? Either move or just dump a piece of property. Maybe they're not interested in it. An example of this is maybe heirs. Maybe, parents died, grandparents died, and people live long distance away, whether it's out of state or out of the county or even at the other side of town. They just don't want to be bothered anymore, okay? Let's take everything, every time they get out of it is pure profit, so take the money and run. I'm not going to spend time over there. I'm not going to fix it up. I'm not going to paint it. I don't want to clean it out. I don't want to do anything. Just sell it, okay? So that's something, if you can find a estate sale or where there's heirs or something like that, that can often be a great source. Sometimes elderly people, they just need to move because they're moving in with their children, again, whether it's across town, across the state, across the county, across the country. Okay, sometimes it's sick or the unemployed. You're going to find, and it's tragic, and I'm not asking you to look at this as taking advantage of anybody else's ill luck, but you didn't put them there, so as long as you're humane about the whole situation, if they need to sell and they need to sell now, maybe somebody's dying and they just need to, they've got cancer, they've got some kind of disease, and they just want to clean up their affairs before they leave. That might be a great opportunity. But you have to have some compassion when you're working with folks like that, okay? Unemployed sellers also, downsizing, economic conditions, when everybody was working, everybody had great jobs, the house was okay, and it was at their limits, but it only takes, for some people, 1 month, 2 months of unemployment, and they are totally wiped out. It's something that's going to take forever for them to recover from. So these are great opportunities for the investor or for the person who's just looking for a really great deal and looking to be able to leverage themselves into the purchase of a property. So these are some of the opportunities of finding a motivated seller. One of the ways, when you're working with your realtor, you can look for properties that have been on the MLS for over 60 days. You can look for properties that are vacant. These are great examples of properties where the seller is probably more than anxious to sell and sell now. Okay? Now, let's talk about another example of finding a motivated seller, and if you find a motivated seller and a way to structure the deal so that everybody's a winner. Let's say that you're approved on 100% financing, and again, just round numbers, we're going to talk $100,000. But let's say you're approved for 100% financing. Well, on 100%, anything over 80%, you're going to pay what they call PMI, which is principal mortgage insurance, and this is to protect the lender in case you go into foreclosure. It has nothing to do with any protection that you have, but it's a very expensive insurance policy, and it's kept on the property until the property value reaches 80%. Now, some policies, and these are the ones you need to be careful of, and they're borderline predatory. I don't want to be throwing stones, but they are predatory, is when it says that your value your loan amount has to reach 80% of the original mortgage amount, or the original purchase price. So if you bought a property for $80,000 or $100,000 on 100% financing, and you have to stay and keep paying PMI until it reaches $80,000. Well, if you're increasing in value by 5% a year, so after 1 year the property is worth $105,000. After 2 years the property is worth $111,000, and so now your $100,000 is like 92, 88, 99. So maybe 3-4 years without even offsetting for the payments that are made, but just the equity itself will increase to the point which will bring your mortgage to 80% of the assessed value. And I bring this to your attention because some PMI policies will not allow you to cancel the policy at that point. They insist on 80% of the original purchase price. So be careful of that, okay? Be very careful of that. Okay. So all right, I got sidetracked there, I apologize. Let's say that you find the property, you're approved for 80%, but or for 100%, but at 100% you have that expensive PMI. So you work out a deal with the seller, and again, maybe it's heirs. They get a loan, they get the payoff for 80%, and then they carry back the other 20. Now when you write an offer where someone's carrying back 20%, use your financial calculator, your realtor's financial calculators, and figure out exactly what the payment would be. And offer them a good interest rate. Offer them like 8%. Okay, that's more money than they would get in the bank. And you show them a nice interest payment. You can even go ahead and say, well, here's 6 months payment in advance. Another technique is to say, well, here's the first 12 months worth of checks. They're all post-dated for the first of each month. Just go ahead and you have to remember to deposit them on the first of each month. All right, so that's a way of getting a seller kind of excited about carrying paper. And sometimes you just do it for a short term, whether it's 12 months or, typically 5 years is the longest before there's a balloon payment, and you refinance. But again, at that point, either you've sold the property or you're going to go ahead and have enough equity in the property where there won't be any problem refinancing and avoiding the PMI at that point. All right. The next section that I'd like to discuss here briefly is how to leverage investment properties, okay? Because the sale of investment property is usually very different than a residential. You're not going to get that nice 6% interest or less even that you can with a primary residence or principal residence, okay? So what you're doing with a commercial is you're doing what they call a paper out. In other words, you're typically going to assume the existing financing that's in place. Most commercial loans do have an assumption clause. Sometimes there's going to be some fees, some assumption fees that could be stiff. But you know what? Write the offer subject to, and most lenders would rather have you take over the loan than lose the loan. Okay, and so it's always negotiable with the lender in that case. Remember that. If you don't ask, you're not going to receive. And it's always better to ask for forgiveness than it is to ask for permission. Remember that. Okay, so then the other thing is that if the seller is willing and is able, then a lot of times the equity, which is the difference between their purchase price and their mortgage and what the sale price is, they can carry that. As a matter of fact, there's typically some tax advantages to them to carry that. So that's another issue that you want to be able to consider and that you want to be able to present. Okay, there's other ways of borrowing money, whether it's a bank line of credit, whether it's leveraging other property. And let's say you're in the gas station business and you own 3 or 4 gas stations. You borrow money against the one that your first one that you've owned that you might have a couple $100,000 equity. You take a couple $100,000 out of that, and then you put that cash down into the new property. All right, so that's leveraging existing property and putting in there. Personal lines of credit. A lot of loans, when you get into SBA loans and such, they want you to use your primary residence. They want to put liens on any other property. If you own vacant land, they want to put liens on all that, and that's leveraging that property in order to buy your new property. So that's one of the great things about investment in commercial property. All right, well, I hope that has helped stimulate the thought process and has you thinking about outside the box about some creative ways of getting into some different types of transactions that you would have overlooked otherwise. So until next time, this is John Occhi with the Excellence in Real Estate team, wishing you and yours all the best. Make every day a great day, because every day is just so precious. All right, thanks so much and God bless. Bye-bye.